Hello and a warm welcome. You've joined us on All About Your Company right here on ET Now. I'm Ashesha Advaryu, and on the show today we are going to put the spotlight on the world's largest aluminium company by revenue, and I'm talking about Hindalco. We are going to talk about that company in greater detail over the course of the next 30 minutes. We will also be joined by Aditya Velekar, Senior Research Analyst and Metals Analyst at Axis Securities in just a bit. But before that, let's talk about the key points we need to discuss and the key questions we need answers to from the analyst who will be joining us in just a bit. First up, the key talking points, and the most important one is Hindalco's expansion plans, not only for its domestic India operations but also for Novelis. What are the kind of opportunities it is likely to enjoy for both India and Novelis? That is the first big question that we are going to put the spotlight on. Apart from that, remember, it also has capex plans at Novelis. What kind of impact will that have on companies' leverage? Aluminium prices have sustained near that $2,800 per ton mark in the global market. Will the up move in aluminium sustain? And if yes, what kind of benefit will Hindalco enjoy on account of that? We will discuss that and more as well in just a bit from now. But as I was mentioning, there are several other talking points. And the most important one is also the Bay Minette capex that is currently underway. Remember, the original plan was only for a $2.5 billion capex, which has now been revised upwards to $5 billion US. What kind of opportunities will the company enjoy on account of Bay Minette capex will also be discussed during the course of the show. But remember, leverage has been a problem for the company. Higher capex is likely to weigh heavy on Bay Minette's projected internal rate of return, or IRR, which was earlier supposed to stand in high double digit, but analysts are now penciling that to come down, and perhaps it could be in high single digit. What kind of impact will this higher cost overrun have on the IRR of the company? We'll discuss that also in just a bit from now. So these are the most important talking points that we are going to focus on. Remember, Novelis is targeting EBITDA per ton of about $600 per ton in the long term. But how soon will the company be able to achieve that? This is also a big question, and we will try to decode all this and more in just a bit. But first up, let's discuss the company, what it is into, and the kind of operations it has both in the domestic market as well as in the international market. So first up, remember, it's an Aditya Birla Group company. It has a market cap of about 1.9 lakh crore rupees. It is a metals flagship company of Aditya Birla Group, which I mentioned, a market cap of about 2 lakh crore rupees. It is the world's largest aluminium company by revenue, and it is also a major global player in copper and specialty alumina. We'll discuss how big Novelis is in just a bit, because remember, Novelis generates nearly 60% of the consolidated revenue for the company. It is a fully integrated player from mining to finished products. It is India's largest producer of copper, even bigger than Hindustan Copper. That's the scale at which it operates. And remember, it is a global leader in flat-rolled aluminium products via Novelis. As I mentioned, Novelis is a major chunk of Hindalco's consolidated revenue because it generates nearly 60% from Novelis. So that's how the company is positioned. Let's also talk about different segments that it operates in. It has presence in 10 countries. It has manufacturing locations in 48 cities of the world. So that's how the expansion and the company's operations are set to happen in going forward as well. So that's about the presence. But let's also talk about the revenue breakup. As I mentioned, it generates 60% from Novelis, 21.5% from its copper business. Aluminium upstream and downstream together contribute the balance 20%. This, remember, copper, aluminium upstream and aluminium downstream are with respect to domestic operations in India, and Novelis is US-based, registered, wholly owned subsidiary of the company. So that's how the company's revenue breakup is split. Let's also talk about the major products that the company caters to and the clientele that Novelis has. Remember, as far as Novelis's aluminium products are concerned, it caters to auto segment, beverage can industry, packaging, aerospace and specialty, and several other segments, but these are the 4 key segments the company caters to. This is as far as Novelis's aluminium products are concerned. Shifting focus to the domestic aluminium and copper business as it is into. That segment caters to building and construction, auto and transportation, electronics and electricals, and this especially is for the copper segment, which generates nearly 20 to 25% of the total revenue, of the total consolidated revenue. That is the segment that I am talking about. Let's also talk about some important clients that the company has. As far as Novelis is concerned, it has some major clients, something like Coca-Cola, especially for the beverage can segment, AB InBev again for the beverage can segment, Ford, Airbus, Jaguar, Land Rover from the auto segment, and these are the segments it supplies its aluminium products to. 5 big companies and 5 big clients that it caters to in the global market. This of course is related to Novelis in particular, which it supplies from their US manufacturing plant. So that's how the entire client base for Novelis is structured. Now, one important factor which continues to weigh heavy, of course, is aluminium prices. But before that, let's talk about revenue. And it has generated consistent revenue growth over the last few years, despite the kind of volatility and kind of business it is into. Now, remember, metals is a cyclical business, which means that it depends on copper prices and aluminium prices in the global market. But despite that, company has consistently reported solid growth. From about 1.32 lakh crore of revenue that it generated in March 2021, it shot up to nearly 2.4 lakh crore rupees in March 25. So clearly, very solid, consistent growth that the company has reported despite the kind of challenges it faces and despite the kind of industry it is in. EBITDA, meanwhile, has also grown in tandem. In March 21, it stood at about 17,600 odd crores. It shot up to nearly 32,000 odd crores in March 25. As far as EBITDA margins are concerned, that too has remained steady on a consolidated basis. However, if we look at standalone numbers, they will look volatile on account of commodity price volatility that the company faces. But EBITDA margins on a consolidated basis look very steady. That should also come up for you on your screens. EBITDA margin figure is the one that we are talking about. Shifting focus to profitability, then that too has been very solid, from 3,500 crores in March 21 to about 16,000 crores of profit is what it generated in March 2025. So that's how the financials of the company are structured. But one important metric to look out for is Novelis EBITDA per ton, because this segment generates most of its revenue, and that is also one metric that we will focus on. Now, as far as first half FY26 financials are concerned, it reported very solid growth in H1 FY26, revenue growth of about 20%. Margins have been steady at about 13%, little volatility here and there, but despite that, continued to remain steady at about 13%. And PAT had also reported a solid growth of about 15 to 20%. So that's how the financials are structured for H1 FY26 versus H1 FY25. But as I mentioned, one important metric is EBITDA per ton for Novelis, and this is something that the management is very bullish about. Remember, currently it stands at about $450 per ton. That's where it stood in the second quarter. But the management says that they are targeting about $600 per ton EBITDA over the long run. Of course, they have not given any trajectory with respect to where they are headed going forward. But of course, they are expecting that they will touch about $600 per ton in the longer term. We'll try to discuss this with Aditya Velekar also in just a bit on what his outlook is with respect to margins going forward. Shifting focus to some other parameters then, and debt and leverage is also another metric to watch out for. This is Novelis EBITDA per ton. As I mentioned, it stood at about 491 in FY25. It of course slowed down a tad bit in the second quarter of FY26 to about $450 per ton, but the management is targeting $600 per ton going forward over the long run. Of course, they have not given any timeline, and it also depends on the kind of market conditions the company operates in. Shifting focus to some other balance sheet parameters that we need to watch out for. Remember, increased recycled outputs, operational efficiencies that the company enjoys, and cost optimization are some of the other factors which will drive EBITDA per ton going forward. Shifting focus to leverage then, and that is one metric that investors should focus on, because remember, that has been a concern for the industry for the last several years, and that is perhaps likely to continue going forward as well. But remember, management continues to remain very bullish when it comes to debt. They are expecting EBITDA per ton, or rather net debt to EBITDA to remain contained going forward as well. Consolidated net debt on a consolidated quantum basis continues to rise on account of capex that the company has, but that's net debt to EBITDA for you. It stands at about 1.23 times. This is as on 30th of September, and the management has clearly said that despite the capex plans that it has, it will not go beyond 2 times on a consolidated basis. So although it looks like it continues to remain elevated, it is perhaps likely to rise going forward, but it is likely to stay contained below 2 times going forward. This is the management guidance. Yes, capex is another important factor to watch out for. 10 billion US dollars of capex is what the company has lined up going forward, and the management is very clear when it comes to guidance going forward. So these are some important parameters that we discussed when it comes to Hindalco's leverage. Consolidated, this is the target, this is the maximum they could breach. From management commentary, 2 times on a consolidated basis. India as of now, of course, is debt free. It has cash in its books, but perhaps even if it were to rise, it will not go beyond 1.5 times. And for Novelis, it will not go beyond 2.5 times. So that's the metric to watch out for as far as leverage is concerned. Now, return ratio, this is of course the return on capital employed, and that too has remained very solid, anywhere between 12 to 20% going forward. As far as valuations are concerned, we compared it with the Hindalco, and look, it looks attractively priced at about 6.57 times. This is 12-month forward EV to EBITDA versus Nalco, which trades at about 7.5 times. So that's how the valuation looks like as compared to its closest peer, and that is Nalco. As far as Bay Minette capex is concerned, that, remember, I told you it's very important, 5 billion capex. It was up from $2.5 billion that the company had originally planned, and it also has a finished goods capacity of about 600 KT. What kind of financial benefit will this have on company? We'll discuss that in just a bit. But another important metric to watch out for is Novelis IPO. Now remember, management had plans of listing Novelis separately on the exchanges, but later it was shelved off because the management thought that it was not the right time, and they are currently focusing on taking that EBITDA figure to $600 per ton. So that is one important factor. Novelis IPO, we'll discuss that with Aditya in just a bit. Lastly, let's talk about LME prices and how they have fared over the last few years. And this is one important factor that weighs heavy on companies' financial, also because it is a cyclical company. Now remember, aluminium prices were at about what, $2,320 per ton. This was in FY23. You can see the volatility in the chart, and currently it is at about $2,600, $2,700 per ton in the global market. So this is one factor to watch out for, because any kind of volatility in aluminium and copper prices in the global market directly weighs heavy on the financials of the company. And to discuss this in greater detail, we are now joined by Aditya Velekar, Senior Research Analyst at Axis Securities, who is now joining us. Mr. Velekar, thank you so much for taking your time out and joining us here on ET Now. How do you view Hindalco, especially with respect to Novelis's concerns that the company is facing? One, Bay Minette capex, which has seen cost overrun. Second, Novelis IPO, which has currently been shelved. What is your view on Novelis part of Hindalco's consolidated business?
Yeah, good afternoon. So thanks for having me on the show. I think we look Novelis as a long-term structural story unfolding. Definitely in the near term, in Q3, we may see some headwinds, especially on EBITDA per ton. That is, as you know, because of the Oswego fire incident. So the management has already guided that the EBITDA will be impacted by 100 to 150 million dollars in H2 of FI in fiscal 26. So that impact will be there, and cash flows will also be impacted by 550 to 600 million dollars. But that will be recovered through insurance claims. So the near-term noise is there. At Bay Minette. Also, the recent capex escalation to 500 to $5 billion is one of the key things which the analyst community will continue to monitor. But I think most of the negatives are now behind us, and as the execution of the Bay Minette projects comes near, the visibility with respect to Bay Minette and entire Novelis will improve. The Bay Minette project is expected to come online in the second half of calendar year 26. So as the 600 KTPA flows in, the EBITDA trajectory for Hindalco's Novelis will rise towards $600 per ton. So there are two, three reasons for that. One is the Bay Minette mill is already contracted for most of its output. Almost 60% is contracted for beverage can segment, for which the EBITDA per ton is already at $1,000 per ton, and the rest 40% is for the auto and specialty segment, where also the probability of getting higher EBITDA per ton is higher because the higher aluminum prices because of this Section 232 in US. Also, if you see the Midwest premium at US is currently at a significantly higher level of $1,800 per ton. And if you combine the LME aluminum prices of spot LME aluminum prices of near about 2,900 to $3,000 per ton. So the company, especially Novelis, is able to pass on the impact of tariffs, and also the scrap spreads has also eased out. So given these things, I think near term in Q3 we may see some dip in the margins, but then in the long term the story should evolve.
Okay, so the story should evolve in the long term. That's the word coming in. But Mr. Velekar, we'll talk about each of these aspects in greater detail. And first, let's talk about aluminium prices, which have been steady. We were just going through the chart of how aluminium prices have fared over the last 3 to 4 odd years. But your outlook on where aluminium prices are headed, say in the next 12 months, and what kind of impact will that have on Hindalco's earnings? So, for example, for $100 per ton movement in aluminium prices, what kind of sensitivity analysis do you draw from this equation?
For each $100 per ton aluminum price, the EBITDA moves by almost 4 to 5%, and EPS also to the similar extent. So any increase in aluminum prices will directly beneficiate Hindalco. So that is number one. Now, if you look at the aluminum prices, there is a structural change in what is happening in the aluminum market. So I will explain that in few points. So number one is that because of the capacity cap at China at 45 million ton, the global aluminum supply demand dynamics is now shifting from surplus to deficit. So the reason for that, number one, is the China has capped its capacity to 45 million ton. That is number one. Then number two is in rest of the world, there are not many smelters coming. The smelters which are coming are most mainly brownfield smelters or replacement smelters. Also in Europe, there are a lot of smelters which have undergone curtailments, especially in Iceland, and a few other smelters in Poland and somewhere else. Also, one of the smelters of South 32 at Mozambique, which contributes almost 1 to 1.2% of global aluminum supply, that is Mozal aluminum smelter, that is not also able to secure power for its operations, and that smelter has also got shut down. So, ex-China, the smelters are not coming up, and as a reason, with China's capacity capped at 45 million ton, the supply-demand dynamics is tilting towards deficit for aluminum, and this deficit could persist for next year, maybe in future also. China is trying to put up some smelters in Indonesia, but there again, they are facing some power issues, and as a result, the supply side looks more structural in nature. The demand is continuously growing at 3% CAGR over the next decade, ex-China, so that is the projections. And there are structural demand drivers for aluminum. We all know that it is the artificial intelligence, then there is aluminum is used in electric vehicles, in solar panels. So all these new age drivers for aluminum, lightweighting use of aluminum in existing electric vehicles as well as IC engines. So all these demand drivers are in place. The structural supply constraints are emerging. Also, Europe is going for CBAM, which also limits the setup of new smelters, polluting smelters. So all these ESG concerns, power concerns, and competitive use of power for other applications like AI puts aluminum smelters on the back foot. So in that context, we have to look at aluminum, and as a result, rightly so, the aluminum prices have increased. And even if it sustains near 2,900 to $3,000 per ton, Hindalco will have a good amount of cash flow. And the stock has rightly re-rated, and the stock price have rallied from what we have seen a year back.
So the use cases for copper and aluminium have increased in the global market. That has led to supply crunch, and that is the reason aluminium prices have shot up and perhaps are likely to sustain at these levels going forward as well. Mr. Velekar, let's get back to Novelis's capex plans then, and especially Bay Minette, which saw capex overrun. In fact, it has more than doubled over the last 1.5 odd years due to several cost-related inflation concerns that the company is facing. What is the kind of IRR that you are penciling in? Is it in double digit, or have you lowered it down to high single digit now?
Yeah, so the management itself has guided that the IRR will now come down from double digit to high single digit. So that is what we are penciling. But again, means the stock has re-rated for multiple reasons. So as I said, bare minute we are still not that concerned because although the cost escalation has happened, there are levers for the company to pass on the cost. As I said, almost 60% of its contracted capacity is in beverage can segment, and in United States, beverage can segment demand is there. There is a dearth of capacity in United States, and they don't want to import beverage cans, can sheet. So Novelis rightly fits in that category. Also, they have an optionality to further increase the Bay Minette capacity by additional 600 KT going forward. So that is number two. Also, we have to see that in US now the scrap spreads have slightly eased. And also, if you see the Midwest premium has almost increased to $1,800 per ton, which helps in passing out the impact of tariffs to whatever 50% tariff impact is there. That will be fully passed on to the customer. So all these parameters are slightly comforting, although yes, capex escalation is one of the key concern, and if it increase further from here, there might be some dent in the overall narrative and numbers. So that is a key risk which we have to monitor. But I think most of the escalation, engineering issues, construction issues, cost inflation, I think as we come near the execution of the project, those things should get structurally tailored out. So calendar year, second half of calendar year 26 is the start date of Novelis Bay Minette project, and if they start it on time and execute it as within the stipulated capex, I don't think there is any risk to the company's outlook.
Okay, so you're not seeing any risk now going forward with respect to company's outlook, at least when it comes to Bay Minette capex. But as far as EBITDA per ton is concerned for Novelis, how soon do you think the company will be able to cross that $600 per ton target that it has set for itself?
Yeah, so I think nearby in Q3 and maybe for this fiscal, the EBITDA per ton may not rise materially. We all know that because the additional capacity from Bay Minette is not kicking up. So that will start from materially from say FY27 and late FY27, and in FY28 that will be fully reflected. So if we take a view of FY28, this 600 KT is coming with a very high EBITDA per ton of almost $1,000 per ton. So on a blended basis, 600 KT, $600 per ton EBITDA looks achievable, but that then we have to wait for that unless Bay Minette starts contributing to the top line. So in the meantime, the EBITDA per ton may hover near $450 to $500 per ton in that range, and I think that is okay because the real change, structural change will happen once the Bay Minette kicks in.
Okay, so that's as far as Bay Minette and Novelis is concerned. But let's shift focus to Indian operations then. Do you think India's standalone, or rather Hindalco's standalone business operations, which is copper, aluminium upstream and downstream, will be a bigger and sustainable growth driver for the company as compared to Novelis, which is slightly volatile as compared to domestic operations?
Exactly. That's the narrative which I want to drive again because Novelis is, I think, yeah, I agree to that part that Novelis is slightly a weaker link and execution will be a key monitorable, and that is the risk for the stock. I want to reiterate that. So if there is any slip up in further capex escalation, then the prices may correct. But then that will again be a buying opportunity for investors. Why? Because at Indian operations, especially at Indian Aluminium, the kind of EBITDA per ton we have seen for EBITDA Aluminium upstream business is almost $1,500 per ton. And I think that has structurally changed now. So it is kind of an annuity kind of scenario we are seeing for Aluminium EBITDA per ton at upstream levels, because this $1,500 per ton could sustain, as I said, because of the structural shift in the aluminium prices, because we expect that the aluminum prices will stay elevated for quite a bit of a time unless some meaningful smelter addition comes in. So from the aluminum perspective, the price support is there. From a cost perspective, the smelters are operating in the first quartile of the cost curve. Also, if we see the global cost curve, the 50% of the cost curve is now operating at 2,000 to $2,200 per ton. So that is a kind of support. So aluminum prices are not going to fall below $2,200 per ton. So that is number two. And then they are focusing on their captive coal mines. So although the progress is not as desired, but still means the captive coal mines like Chakla and Minakshi and Banda coal, all these three coal mines will start contributing from FY 28-29 onwards. So the captive percentage of coal will start increasing from current almost 0% to 50% by FY 28. And then renewable energy is also increasing almost to 30% by FY 33. But that's still long way. But even if you see currently the coal prices are quite subdued. Even coal prices of Coal India, the e-auction coal also, they have coal linkage for most of their coal requirement. So from a cost perspective, the upstream aluminum business is also quite stable. The downstream business is a business where we actually see the re-rating kind of EBITDA, because in Q2 we have seen that EBITDA has almost crossed to $60 per ton, and the management has guided that EBITDA per ton will translate and will further increase to $300 per ton. That is
Correct.
because they are expanding their downstream capacities. Then in copper,
Right.
yeah, in copper we have seen that the TCRCs is a challenge. The TCRC has been contracted at a lower level. Yeah, but then they are converting that copper to CCR and further to, so the byproduct revenues from copper business and the downstream copper business will generate a good amount of EBITDA.
Right. So the outlook for India operations continues to remain very strong, although there's some bit of uncertainty when it comes to Novelis operations. That's the word coming in. Mr.
Yes.
Velekar, thank you so much for taking your time out and joining us here on this special edition of All About Your Company. And with that, it's a wrap on this edition of the show. Thanks so much for tuning in.